weakness to unfilled down gaps. A little bit of a bounce yesterday. Now we're gapping down big below yesterday's lows, which is what you'll see over here. These are the Russell futures, the S&P 500 futures, NASDAQ futures, and the Dow Mini futures. I've also got oil and gold down here in the bottom right. Now, I just finished running a study. My goal for the next hour and 15 minutes is to basically let you watch me evaluate the morning's action. And if I have a setup to trade, I will trade it. Tell exactly what I'm doing, where my targets are going, stops, and so on. But primarily, I want to show you my approach, which is really sort of a homegrown approach. It's mostly mechanical and systematic, but with a slightly different spin than you're probably used to seeing. The core of what I do is to evaluate every setup, and I primarily am a gap trader, but also trade the intraday 15-minute range and hourly range. So my approach is to evaluate each setup with at least 3 different complementary, lowly correlated systems, meaning I've got historical data, which I'll be showing you, coming from 3 different systems, evaluating each of these setups um, in completely different manners. And then if the historical data, the average of those 3 systems, shows the odds are in my favor for taking a trade, I'll take it. If they don't, I won't. And sometimes they're a little bit gray, and I'll use some discretion, reduce my position size, and do what I call a discretionary trade, which is probably more akin to what most of you do. But I'm really a mechanical system trader. I just happen to use multiple systems, and um, I do have some mechanical systems that trade on the side behind the scenes for me. It's a great form of diversification. But what I'll be talking about today is my interpretation of my historical data that comes out of my database. You'll get to see it all. You can ask questions as we go along. I'll do my best to ask questions. Um, Anything goes. But my primary focus is to trade just as if you were not here. So if it sounds like I'm talking to myself, it's because I am. That's what I'm doing is I evaluate the markets, and if it spurns a question, go for it. With that said, I just finished running one study that I want to post. So give me about 30 seconds here. And what I do, I've always written down my trading plan. I've been doing this about 10 years, full-time, primarily a gap trader. And I've had a lot of success in writing down my plan of what I'm going to do at the official New York Stock Exchange Open, i.e. 9:30 a.m. Eastern Time. In my thought process for doing so, it becomes a great way to track my own analysis, to do postmortems when I make mistakes, but also uses information I share with folks that follow me. I do run a member site on the side. We have actually a pretty big following, hundreds of traders around the world that use my historical data, and I post my plan about this time each day. So that's what we've got to do right now. We are clearly, and then I'll show it to you, um, we are clearly showing large gaps down. This is the futures market. We're way down in the Russell futures, down about 25 points from the blue line, which is yesterday's closing price as of 4:15 Eastern time. Way down in the ES, right at a 1% down, right? We're down about 20 points from the blue line, yesterday's close. NASDAQ down big also, and NASDAQ down big. All of them are below the red line. The red lines represent the prior session low, and everything I do is directly or indirectly related to zones, opening zones. And I'll show you my exact zones. In fact, that'll probably be the best tip I can give you to incorporate zones into your trading. And I'll show you mine and my nomenclature in just a moment. But what we see here in the study I'm adding is it's clearly going to be a very large down gap. I thought we might rally a little bit this morning and have a smaller gap, but we're going to be right around 1%. So I just ran a study. In fact, I'll pull it up. You can look at it. That's what you can do, is I type the summary into my plan, which I'll be showing you. Where is it? So Gap Trader is my back testing tool. And I can find it in my business screen here. This is the historical results of fading, meaning buying a large down gap. And I've defined a large down gap as being more than 3/4 of 1%. 3/4 of 1%. So 1% is roughly 20 points. So as long as this gap is at least 15 points in size, this is the odds, historical odds for the past 10 years roughly, of going long at the open Double check my stop settings. Going long at the open, targeting gap fill, and using an intraday stop. I use 30% of the 5-day ATR. I'll get into that in a moment. But basically today, and I have a minimum of 5 points. Today's stop is 5 points. So this assumes 5 points. Only a 26% chance of making money. And historically, it's lost money. See the total net profit on 10 contracts in the ES mini futures? Lost a bunch of money. Profit factor 0.5 is simply a ratio of historical profits to losses. It's lost twice as much as it's made. This is an easy pass for me, but it confirms my analysis that I'm also going to show you. So take that in. Let me type that up. That is 11 of 41 wins, 27% win rate, and 0.5 PF. That is not attractive. So this is a little bit of a challenging type of presentation, trying to give a presentation. So I just, while also trading, I decided it was probably more valuable since a lot of people show a lot of slides, and slides won't make you a nickel um, in the grand scheme. I thought it may be more helpful for me to simply, again, show you how I think about the markets, the data I use to make decisions and answer questions in real time. From time to time, I may pull up a slide, but I don't even have this handy. Actually, I do have them handy, but I don't have them open right now. So I'm going to start with my analysis of today. And it's probably going to confuse 95% of you with all the data because I'm going to go through it very quickly. What I want to do is show you exactly what I do and many of the folks that follow my research and methodology, how we approach the markets each day and come to the decision that today is not a good day to trade. And here we go. So we have 5 minutes before the open. So I track where the overnight futures are trading. While there's technically not a gap in the futures, right? They're trading almost 24/7. I ignore the overnight action. It gives me an opportunity to, that's what creates opportunity, I should say. It's the overnight action that creates the gaps up or down. And 70% of the time, here's a great fact, 70% of the time that a market gaps, it will fill that day. And I'm primarily talking to the index futures, about the index futures. So 70%, that's why I'm a gap trader. Big money's not going to chase the gaps. They're going to wait, and if anything, try to push the market back to the prior day's close. So 70% of the time, wherever it opens, it's going to end up back here. Now, today is such a large gap, and the technical setup is so weak, it's more of a 50-50 trade at best. But right now, I see we're in this UL zone. U just means the prior day closed up, right? We had a green candlestick. You see that right there. And we're opening below yesterday's lows, the UL zone. My nickname for the zone, by the way, is a blood gap, below the low of an update. It sounds bad because it often is bad. It is not a money maker for going long. If anything, I generally think about getting short. But let me finish my analysis on why this UL zone is bad today. UL zone, UL zone, UL zone, and the Russell's in the DL zone. I pay attention to all three closing prices. I'm primarily looking at the last trade of the prior session as of 4:15 Eastern time, but I track the 4 o'clock close also. That's where the ETFs, the spider in this case, would be trading. And settlement, not so much, but I keep an eye on in case there's a large variance like at the end of the month. So I'm going in my worksheet. And actually, let me just, I want to do this. I'm going to start with the end in mind and tell you my summation, and I'll go of it because I do an awful lot of analysis each day. So here's the key takeaway that was just updated for our members. So as of about 9:10, when I was writing this, the future indices are showing large down gaps below the prior lows. That's the prior session, regular trading hours low, with most poised to open in the UL zone, below the low of an update, blood gap. I'll start with my comments. The guides are showing overall neutral to weak odds for fading. That means going long if the gap is down, gapping down below the prior session lows. So it's neutral to weak. That means in terms of win rate and profit expectancy, the latter being the single most important metric to know or estimate every single day for every single trade, profit expectancy. The unique factors shown above, so this is some complementary research to my database I'm about to show you, um, show mixed factors for fading down gaps. See, down gap today in July during bullish markets historically has been a dog. Only 15 winners out of 35 attempts in the past 10 years. That's buying down gaps in July during bullish markets, generally not good. I do a video just about every day, and I show that down gaps this part of the month, actually it's a unique part of the month, tends to be pretty solid. But with this large gap, I'm discounting that big time. And then as I just showed you that I was typing up, fading large down gaps greater than 3/4 of 1% after closing above the 10 and 200-day moving average, problematic. So this is an easy pass for me at the open. I'll wait and take my cue from the range guides, meaning I'm going to wait until the 9:45 Eastern time mark, about 15 minutes from now, to see what the historical odds are for trading around the 15-minute range high or the 15-minute range low, going long or going short. I'll get more into that in a moment. The key thing here is I'm trying to really keep this, do deep dives to show you my research, but keep it at a high level so you don't get completely lost. The key concept here is that I'm not sitting here evaluating indicators on charts. They're sort of like Ouija boards in my opinion. And I know I'm probably irritating and upsetting the 500 educators who sell indicators on the web. I'm just not a big believer. And the reason I'm not a big believer is that I'm a show me kind of person. And I have got a database of, and many of our folks, of thousands of unique patterns in the database. You name it, I've probably got the pattern in my database. And very, very few have consistently made money over the years, virtually non-existent. So I'm not a big believer in trying to subjectively interpret these patterns because, again, you can get them to say whatever you want. I can show you the most bearish patterns that consistently fail during certain market conditions. I can show you the most bullish patterns that consistently fail during certain market conditions. So it's too complicated to remember which ones are which. So I've got the best ones, the complementary with different time frames built into systems, and they help me evaluate the market each day. So markets right here, I'm going to be switching over slides, but let me show you the analysis that led me beyond this. So when I talk about our gap guides, so I have guides that I've created, and I use all of these. Everything on our site is stuff I created or folks helped me create that I use for my trading, and I've had great success over the years. So let's look at the gap, the UL zone. This is S&P 500. Opening the UL zone, that means opening below yesterday's lows, the number shown right there. Slide all the way to the right, using 3 different systems, a market condition system, a pattern system, and seasonality system. A whopping 46% win rate. That's not very good when you consider the average, and this is assuming stops as well, shown here, the stop here. The average with the stop is about 65%, or 60 to 65%. Profit factors interesting. It's actually made some money. It's made 35% more in profits and losses in the ES historically. But that's not as compelling as it sounds for me. And I'm very win rate sensitive. I like to have, at worst, 3-4 losing trades in a row during the course of a year. So my target win rate is 65 to 70%. And I've done a pretty good job of, actually very, very good job of being right in that range year in and year out. Now to do that, my average winner is a little bit smaller than my average loser. We can come back to that, but let's evaluate it. So at a glance, I just see, nah, nothing there. If we'd opened up higher between 58 and 62 in the ES, let me slide this over, been a different ball game. Numbers much better, but nothing in this UL zone. YM, yuck, 37% chance of making money. Interesting, NASDAQ showing very strong numbers. Now, this means it's less than 10 trades. So that makes me discount this number a lot. Pretty rare 3-day pattern. This is a 3-day pattern system there. And then the Russell, slightly attractive. It's a pretty mix, as you can see. I always, by the way, even though I primarily trade the ES, I'm always looking at all 8 indices, or the 4 indices, both futures and ETFs. So that was the futures, because they're highly correlated. If they're not giving you the same data, then that's a flag. So that was the futures. Let's look at what the ETFs show, corresponding ETFs. So if you're an ETF trader, Spider, ooh, yuck. Spider did not confirm the good number, right? Spider here did not confirm the good number from, or the better number from the ES. It's actually worse. Again, a pass for me, nothing there. Nothing there in the diamonds, 35% win rate, 44% win rate in the Qs, and 57. Again, the Russell looks a little bit better. So hopefully it stands out to you that this is not the greatest of setups. Now I want to be really clear about something. This is what people get confused on. And this is simply a reflection of three complementary, lowly correlated, optimized, that's important, systems. If any system traders out there, you know the risk of curve fitting and so on. No optimizations here. This is just breaking down each of these markets by their opening potential zones today. Um, the market can and will do anything on a given day. I have found 2 times out of 3 historical data does a fantastic job of keeping me in the right side of the trade. 1 time out of 3, the market's just going to do something that doesn't conform historical norms. So today's gap could rally all the way and fill, and you'd say, oh, look, he was saying the gap wouldn't fill. Wrong. I'm not saying this gap isn't going to fill. I'm telling you that historically, under similar scenarios, there's about a 40% chance would be my best average if you average that all up. Um, all the data I've got today that this gap fills. That's still 4 out of 10. 6 out of 10 times it won't. And for me, that's not good enough for my likes. So nothing there. What I do each night, I actually don't look at these first. I look at these only if there's a trade. But I knew this would be confusing if you didn't understand what I was talking about with these zones and these 3 different systems. I have a worksheet that summarizes it all. Just a simple spreadsheet tool. Basically, it takes all 8 indices, guys, that I just showed you and averages them all up. It's a weighted average. It's actually a 50% win rate from those 8 indices. 1.5 profit factor. It's telling you there's been money made by going long. So but it's only a 50-50 trade, and that's not good enough for me. So that to be thinking about the long side, if I get an opportunity with the 15-minute range or something similar, well, not a discretionary trade perhaps. So I do have a slight bias for looking that way based on this data. Unique patterns, we had a unique pattern play. We closed above the 10-day moving average yesterday after closing below it. Down gap since under similar scenarios, 70 trades. Slightly attractive. Again, this large gap size really discounts a lot. Now here's where I pull it all together. In fact, let me see if I comment. I may not have commented on it. Oh, it did. So I told you unique factors were mixed. The closing guys are showing a neutral to bearish bias for the day. So I use all the information I can get my hands on. The gaps, I told you, were mixed. The closing guys, check this out. This is simply the odds of closing above the open at the end of the day, depending upon where the markets are trading. Hold on 1 second. So the ES open, see the white line was 47.50. Where did my data go? There we go. 47.50, that's down below this level here. So these are just mathematical calculations. I use 40% of the 5-day average true range. 40% of the 5-day true range. Right there. This is 80% there. So we're below the 80% level. Pretty rare, only 51 times that we had a gap this large under similar scenarios. This is 5 completely different systems. They're specifically designed to evaluate market conditions, trend, momentum, volatility, overbought, oversold, seasonality. A lot of ways to do those. It doesn't really matter how I do it. I'd be happy to talk about it if we have time on each of these. But what is of greatest value is when you look at the average of those 5 different ways of evaluating market condition, combining it with gap direction and size gives you a really good scenario here. Hold on, sorry about that. Sure it's not a school. This far right column says end of day stop. If you go long at the open, hold it all day, 59% of these have finished above the open. Hasn't made any money. The 0.9 profit factor. So it's actually lost a little bit of money there. Let's look at the YM. YM open down here of 16,742. Slide over here. Yep, way bottom level. 56% under similar market conditions have finished above the open, made a profit factor of 1.5. NASDAQ, 61% have finished above the open, but lost money, 0.73 profit factor. So the average loser has been pretty substantial. And then Russell showing the same thing. The column just to the left said, what if you went long and used an intraday stop and get similar numbers I showed you from our gap win rate, made a little bit of money, Dow doesn't look nearly as attractive. NASDAQ doesn't look attractive. Ooh, and Russell been a dog as well. So really pretty mixed data, neutral at best to weak. And this is odds of going long at the open, holding all day, based on 5 different systems and opening gap direction and size. Let's go over to my 5-minute charts. Market's trading up about 3 points from the open. Let me familiarize you real quickly. Got a great question from Gillian, Jillian, however you pronounce your name. Sorry about that. There's oil down here and gold way up here. Also got, it's new data. I'm not trading them yet, but I can evaluate it. So this is the Russell futures, S&P futures. These are regular trading hour charts. This price action you see here is yesterday's regular trading hours. NASDAQ and Dow, gold and oil. 3 market internals, the least important things for my methodology. Tick, 80 ratio, and trend. All 3 are bearish, and this is a volume, S&P volume here. So we're working right to left. Trend is above 1. That means it's in a bearish area. If it's trending up, just pushing up a little bit, that's slightly bearish. Confirmed by volume. Aggregate volume is down. Been more selling than buying. 80 ratio very weak at 0.2. In fact, this is so weak, the path of least resistance may be to the upside. We'll see. Sometimes the market can go too far too fast in the overnight. And then ticks have been negative, yet to make it to the 0 line. When we first test that 0 line, what it does from there is going to be important. Now, if you look closely here, some of this might be hard for you to see. Let me expand a little bit. These green levels, these are confluence areas of potential support and resistance based upon pivots, Fibonacci's, daily, weekly, monthly time frames. There's a lot of room to run if we break down from here till we get down to 3940 area in the ES. So it'll be pretty important how we handle this confluence area that we're running into right now. I have 15-minute range guys coming out in just a moment. Let me answer Gillian's question first. Actually, let me ask Frank a question. If I'd had a trade, I enter at 9:30 a.m. Eastern time for 95% of my trades. It's very binary, unemotional. Time activated orders is easy to do in multiple accounts, so you can just manually place the button. But I'm trying to do it right at 9:30 a.m. Eastern time to either go long, the gap is down and it shows strong historical odds, or to go short. The gap is up and it shows strong historical odds. So you trade based on what the past statistics are. You haven't looked at any charts yet. Why not just let the market show you what the market wants to do now? Great question. Because that is the least reliable way to consistently make money. Hate to burst anyone's bubbles. Very, very, very few traders make it interpreting chart action. I don't know the exact numbers. You talk to the brokerages with discretionary trading, which is what most people do. That's why 95% of all traders fail, in my opinion. Charts are highly subjective and interpretive. Your emotions get involved. I tried it, by the way. I actually made money. My first year of trading using nothing but charts and indicators, I actually doubled my account. I doubled a 6-figure account my first year of trading. I thought I was God's gift to the trading world. Sadly, I was not. What I realized was that I had a strategy for, I was primarily going long during the raging bull market of 2003. Anybody could have made money that year going long with a long bias. When the market turned sideways, all of my indicators and the multi time frame system I was using that I spent 20,000 on, all of it stopped working. Literally, I followed the set of rules perfectly, let the market tell me what it was doing, and guess what? I got run over, giving back almost all of my profits that I made in about 10 weeks. So what I realized, and I'm fortunate, I'm really blessed. The reason I'm here today is that I made money my first year basically by luck, and then I was smart enough not to give any of it back, or not to go into the hole on the second year, and I had a loving, supportive wife who allowed me to dig into this. And what I realized was what I was lacking was simply waiting on the charts of the price action to tell you what to do. How do you do that? When is enough enough? I've studied all the just about any indicator most of you folks are using, and they just give inconsistent results for different market environments and conditions, and depending upon other factors in play. The markets are not simple enough to boil down into one or two indicators. They're even three or four. That's why even the best system has its limitations, because you've only got so many different indicators you can put into a system to evaluate market action. The markets are way too complex. So if you've got something that's working, great, but don't bet the farm on it. It will fail, and it will fail badly at the worst time for you. So, um, and again, I'm not trying to, I really appreciate the question from Gillian or Julian. It's what I realized was I didn't know when. So if the markets told me to be long, I didn't know what the optimal target was. When do I get out? When the indicators turn down? Well, guess what? When the indicators were turning down, I'd have lost my butt half the time. And I had no way. This is a real important point. If you wait till the indicators to tell you to do something, how much risk are you taking? Do you know how big your size is going to, how big of a loss you could take? Most people don't. And if you don't know that, then how do you do effective position sizing? You can't. That's why Wall Street doesn't have traders sitting here managing big money looking at charts. Now, there are exceptions to every rule, but most of the data, most of Wall Street's trading quantitatively. Um, so that's my view. Obviously, you got to trade your own beliefs. I'll say it this way, and I do have and I do use charts. I'm looking at charts. I've got confluence on charts now and different indicators. Um, I don't know anyone that trades, and I've worked with thousands of folks. I don't know any of them that are pure chart-based traders that make it year in and year out. Um, so I know there's some that probably have. And there are probably some educators that will tell you they have, and they may have. I don't know. Um, but I do know lots and lots of people that use historical data like me to guide their decision making. So, in fact, some of the folks that I know that have been most successful will interpret charts, but they rely upon the historical data like I've got to confirm their directional bias. So you can use it as a primary methodology like me, or you can use it to support your trading decisions. All right, 15-minute range is coming out. This is going to be a little bit confusing, but all I'm looking at here, see this low line, this purple line here, 1945.75. There's one up here below 1951.50. That's a 15-minute range high, 15-minute range low. I want to know the odds of the market continuing higher if it ticks one tick higher than today's 15-minute range high, or should I be considering going short? What if it ticks one tick below the low? Should I consider going long here for a fade or getting short? So let's look at the data. Got a high breakout, low breakout, high fade, and low fade. And most importantly, let me say one other thing back on the technical trading. You can learn how to interpret charts, but it will take you many years to do it properly for a wide range of market conditions. Most people don't have years to learn how to trade successfully. So using historical data, you can get the knowledge at your fingertips of a seasoned pro. I started crunching data when I did. Look at my 15-minute range guides. We're a little bit, actually right in the middle of today's action. So I'll start with the high side. What has happened in the markets historically when we've tested the 15-minute range high under similar market conditions, patterns, and so on? So high side, high breakout, going long one tick above, at one tick above the high of the 15-minute range, which again is 51.50 here. Dead neutral, 51% win rate, percent for fading. Both have lost a little bit of money. No thank you. That's using a 4-point stop, and today a 4-point target. Continuing real quickly, nothing in the YM. I'm looking for confirmation from multiple markets also. High breakout favored in the NASDAQ. That's interesting. High fade not. See that? Bad data there, good data there. And Russell. So you got 2 of the 4 markets favoring the high breakout, 2 not. Look at the ETFs. High breakout spider is favored. So that's also showing the same thing that the Russell and the NASDAQ feature show. Neutral in the diamonds, high breakout favored in the Qs. That's 4 markets now. High breakout favoring the Russell. That's 5 of 8 markets favoring the high breakout. I'm looking for 6 of 8 markets to meet my criteria. And when I say favor, I'm literally looking for 55 and 1.1 on my criteria on these range guides. Very close, but that's enough to get me interested and to consider taking a high breakout on a delayed entry. Let it break and buy a pullback. That's probably what I'm going to do. But let's continue. We're going the opposite way right now. See, we're tracking down to the 15-minute lows. I'm going to look at the reverse order low side, and I'm hustling trade. Low breakout 55 and 1.08. That's right at my criteria, but doesn't quite meet it, but certainly favors the low breakout in the Russell. Not confirmed by the NASDAQ. That's more leaning towards the low fade. Low breakout favored in the diamonds. Low breakout favored in the spider. Again, I'm looking 55 and 1.1. Two favor, one close, one doesn't. A little bit mixed. Look at the futures. Look at the weighted average of three systems evaluating different time frames and scenarios. Low breakout favored also in the ES and the Dow. Neutral in the NASDAQ. And right at it. So we're going against the NASDAQ. And I've got, so 1, 2, we'll call that 2.5 points out of 4. That's how I score in my head back to the futures. Well, that was the futures, the ETFs. 1, 2.5 again. So again, doesn't meet straight up 6 out of the 8 meeting my criteria, 55 and 1.1, but 4 do, 2 are close. The majority of indices are favoring the range breakout. So that tells me to take these trades, but on a delayed basis. So here's what I'm going to do. Let me get back to the bigger charts. Again, that's showing pretty much take the 15-minute range trade. It's showing some bias. I'm either going to make 4 points, lose 4 points. If you can't afford that, then don't trade. In fact, you shouldn't be trading anything just because I'm saying it. I'm trade with the historical probabilities on my side hundreds of times a year. That's my edge. So there's no confluence down here from the charts. What I do for confirming trades that are leaning in my direction but not quite meeting it is I will let it trade at least 2 points beyond the range, so 2.25 points in either direction, so either to 53.75 and buy a pullback to 51.75, or vice versa if it breaks down to 19.4350, 2.25 points below today's low, I'll short a bounce. Now what if it doesn't bounce up or pull back? Then I missed the trade, so be it. It wasn't an ideal scenario. So I've got a little bit of time. I don't have to set that up yet because I'm going to let it trigger first. Let's see. How far back would you reckon is a good period to give you a clear picture of how the market is going to move? So again, this is a subtle thing. This is hard for people to understand. I believe in a 10-year window of data. 10 years encompasses most wide-ranging market conditions from very bullish to very bearish, slightly bullish, slightly bearish, and gives me enough sample sizes to evaluate. Anything less than 7 years becomes problematic. We use 7 for gold and oil, which we can talk about in a little bit if anyone's interested. But I believe 10 years of data is enough. The subtle thing I want to point out again is I never have a clear picture of how the market is going to move. And I'm not trying to be a smartass. I'm just being very honest. Anyone that tells you they've got a clear picture, you should run from, okay? No one knows what's going to happen in the market on any given day, period. It's just not that straightforward. I know if you're new to trading or new to active investing, that's what you want, clarity. And it's very easy to be seduced by someone who gives you that instant clarity. That sounds great, but they don't know. Nobody knows. So I don't know. But if I know that historically a similar setup has worked, say 60% or more of the time, and it's made good money, then I'm going to trade. So all I'm trying to do is trade with history on my side. That's it. I have a lot of folks that follow me in our data that says, well, you know, I had a decent methodology. I wasn't making a bunch of money. I was break even to positive most months, but not a bunch. I started looking at your data, and now I simply avoid a couple of those trades I used to take because I see they're going against clear historical odds or biases for the day, and now I'm markedly more profitable. That's a great way to use historical data. So it's just telling you what's happened what has happened most frequently historically. And when that is fairly clear or biased, that's when I want to trade. What is my screen name on my, I don't even know what that is. FX, that's Forex. I don't trade any, that's the one thing I don't trade, foreign exchange or any other tracking website. I don't, I don't use a tracking website because it's really not a system per se. And I tell people, everyone, you don't join Master Gap to follow me. You join Master Gap to use the historical data. Um, it's not an automated or mechanical system, if you will. Best thing I can tell you to check out on Master Gap is, and by the way, I posted live trades for 3 years when I started out. Every single trade. In fact, I called out every single trade before I do it. I put it in writing. I'm not even calling it out. I'm typing it up, sharing it with our members. Well, not every trade. The opening gap, which is my bread and butter, 10 minutes before I do it. And if you go to our website and check out what a member said, these are all verbatim testimonials I've accumulated over years, you'll see the difference that people have said my data has made for them. So I've redacted profitability numbers to be in compliance with various brokerage firms and the CFTC and NFA. But they're all awesome numbers. Believe me, I did that begrudgingly. That said, not everyone makes money using my data approach. It's really up to you. I can't guarantee you'll make money. It's how you interpret the data and how you use it. If you use too much emotion, too much discretion, you try to pair trades, I guarantee you won't make money. If you follow basic, simple guidelines for trading with history on your side, I won't guarantee you. You can still undermine yourself, but your odds of not being successful um, go up quite a bit. All right. Came in late. Want to know, do you do the same analysis for crude? Yeah, let's look at that real quickly. And hold on one second. Josh Schloss says, what to trade? Let's make some dollars. Josh, you go for it, buddy. I'm not trying to be too aggressive with you, but that's not the right mindset, in my opinion. Uh, I don't ever come into the market and say, oh, I'm going to make some money today. Never. That's why I'm still here, okay? I'm not trying to trade for trading's sake. I'm trading to um, only trade when there's an edge. And if I do that, then I make money, okay? So I'm not going to force a trader to do anything. The trades I'm evaluating that I will trade, 15-minute ranges, I told you, if we break the high or low. Otherwise, there's no edge. I don't have an edge. If you got an edge, go for it. I don't have an edge, so I'm not going to waste my time and money. Most people overtrade. I average 50 to 75 trades a year on the gap, and probably the same on the range trades, and maybe an equal number of discretionary trades. So I may do total an average of one trade a day. I'm only trading the first 2 hours of action, and I'm only waiting for the best setups. Now, I recently added gold and oil to diversify and give me more things to look at, but I've done very well being very selective, if you will, and very focused. So let me look at the next question that I have from Najib was about crude. And just to bring closure again, Jillian, I'm looking at the gap trade. Do I go long or go short? My data was mixed. Did not show a clear edge, showed more risk to the downside, so I'm a little bit, but it was actually more data to the downside. It was mixed. That's what I got to be unbiased there and objective. It was not as lopsided as it often would be. So I'm looking for, right now, I'm looking for a break of the purple line that's at 1951.50 or the purple line at 1945.75, the highs and lows of the 15-minute range in the ES. Many of our folks will trade these other markets, the Russell and the NASDAQ and Dow. I'm just trading primarily the S&P. If it breaks, then I will set up, and by more than 2 points, then I'll set up a trade to get long or to get short. If it breaks either one and go in that direction. My edge is simply robust historical analysis of multiple market conditions, patterns, and seasonality effects on how markets have performed under similar scenarios. So I've got multiple systems, and I only trade when the average of those systems show me an edge. So let's check out oil. Oil opened down at 9 o'clock. In fact, the first hour range is coming out in just a moment on that. And it's going to be based upon 101.86. So we'll evaluate the oil first hour range and 102.22, the yellow line up here, the high and the low. It opened in the DCL zone. So let's look at that DCL zone data real quickly. Yeah, I'm not doing subjective interpretation, folks. I'm serious. And I know there's a lot of people don't like to hear this, but that is not the way to consistently make money. That's a way to get yourself in a lot of trouble if you're not careful. I know a lot of people do it, and yes, there's some tremendous educators that have been doing it for 20 and 30 years. The average person cannot learn how to subjectively um, to the indicators and price action all depend upon market action, all depend upon market conditions, and that's why I just let my systems tell me when there's an edge and when there's not. Keeps my emotions out of the way. All right, look at oil, commodity futures, gap guides. These just came out. We opened at 102.06. Real quickly look at those. Copper, gold, silver, and oil. GCL zone, 70% win rate, but hasn't made much money. So 70% of the time when opening between 102 and 102.24, GCL zone has been a winner historically. Hasn't made much money though. So you get one system, market condition system, looking at past 2 to 6 weeks, has lost money, has been made money about 59% of the time, but has lost a lot more than it's made. A profit factor less than 1 is a money loser. A profit factor more than 1 is a money maker. So one system making money, one system not, other one pretty neutral, no edge. So that means most of the winners were pretty small, the losers were bigger. Let's look at the first hour range in oil since that's coming out in just a moment. In commodities, sorry about that. And it's not out yet. CL first guy's not supposed to be there at 10 o'clock. Philip, I'll come back to it, but those live trades, I've got a year or two in my member area. It was on a blog that I ran. It's how I developed my following, quite frankly. I've got several hundred folks that follow me. Um, they were my biggest testimony. 60, more than 60% of my members have been members for more than 2 years. Guarantee you won't find many websites that can say that. I think say it, but I can prove it. All right, let me refresh. Oil is now out at 10 o'clock. We're looking at the high sack was right at the high here. So going long on a high break, first hour patterns, gap zone, and 3-day patterns has made money 51% of the time with a stop equal to 30 cents and a target equal to 20 cents. And you've lost money. 0.74 profit factor, less than 1 has been a money loser. High fade has been better. That means going short right here, right at the highs. 57% of the time has hit the target at 20%. Stop 30%. But hadn't made any money. Profit factor 1. No thank you. There's no clear edge there. If anything, there's more risk. So historically, these three systems don't show much of an edge for oil today. Anything can happen, but three systems I found that work really well aren't showing an edge. Reverse on the low side, again, no edge there. Not much going on. See, I'm looking at the gold numbers today. Gold, first hour range is at 920. Hasn't broken it. See, gold. So going short or going long, you can look right up here at GC. Showing remarkably, well, not remarkably, but similar numbers to oil. No edge. Low fade, no edge. Looks like silver, which I don't have on my charts. We literally just got silver showing an edge for the high breakout, going long on the high breakout. So there's a slight proxy, a slight correlation with silver and gold. And maybe gold has a little bit more of an edge than that data is suggesting. And copper, I don't know a thing about the copper market personally, but not showing an edge there. Okay, so oil is breaking. Will it go higher and become a winner? Could. Just hasn't made any money historically. 60% chance it will. It just hadn't made any money. So yes, I can, Eric. And I know some people are joining later and all that. And as I explained, I'm not big on showing charts when the market's live trading. Just summarize, if you are joining us, the trade I'm waiting on right now is to get long on a pullback. If we break this 1951.50 area, the high of the 50-minute range by 2 points. If it goes up more than 2 points, I'll buy a pullback. If it breaks down the low by 1945.75, then I'll short a rally. That's my current plan right now. The ranges, let's look at, this will be a cleaner view here. in gold. So this is the first hour of gold. It opens at first 2 hours of gold. First hour and 40 minutes opens at 8:20 a.m. Eastern time, and today it opened at the white line 1344, well above its close from yesterday at 1324. So that's almost a 2% gap up. That's a pretty sizable gap. So when I see real large gaps, I discount even my range numbers a little bit because it adds um, a different element. Actually, what I do is we run testing in our trading room to see what the data shows for that day. But we opened 1344.40, and then the high came up here about the third candle, then sold off. Magenta lines of the 15-minute range high, 15-minute range low. The gold lines of the first hour range high, first hour range low. Those range highs and range lows create 4 different trades. You can go long on a break of the range. You can go short on a break of the range. You can fade, meaning go the opposite direction of the first hour's high. So if it gets back up here, that's what the high fade means, going short at a test of the high, targeting, what did I say, I think gold, actually I don't remember the numbers on gold. I think oil was targeting 20% with a 30-cent stop. Using mathematical calculations generally equal to 20% of the 5-day ATR or 30% for the stop. And then the low fade would be to buy a test of the lows and go long. So 4 different setups. So think of it this way. I know a lot of people, and I know I'm pretty strong about this, and I don't want to apologize for my beliefs because my beliefs are founded in facts, not my opinions. These are factual-based studies. Thousands of patterns I've evaluated over the years. Squeezes and Keltner channel breakouts and moving average crossovers and triple movements and just about everything I can test does not have an edge. They just don't. They're not. An edge in my mind is something that works the majority of the time, year in and year out. Now you can combine them with other indicators and that helps. That gets really complicated and adds a lot of subjectivity on which indicator, which time frames you're using. And it just becomes this holy grail thing where people chase these indicators trying to figure out what's going to happen. Afraid to miss out on a winning trade. I don't. I'm waiting for the market to come to me. Market's undecided right now in gold, right? So let it decide what it's going to do. Instead of me getting wrapped up in the volatility, let it decide, make a move, see if the historical odds show an edge, and if so, then I jump on the train. It takes a lot of patience to do what I do, and believe me, I'm not a patient person, but it's amazing how trading on a discretionary basis and losing money for you, which will happen to everyone at some point, um, will teach you a lot about the market and what to do and not to do. All right, we're getting closer to the highs here, back in the ES. Yeah, if anything, the most common patterns are used by market makers and other professionals of Wall Street to go the other way. That's why you see so many failed breakouts. Okay, we're breaking above the high. Remember, I had 5 of the 8 markets basically favoring the high breakout. So I need to rally just a little bit, and then we'll buy a pullback at 51.75. It's got to go to 53.75. I want it to break by more than 2 points. Then I'm going to buy a pullback right now to 51.75. And just make sure I'm ready here. Let me take a look at the confluence while I'm waiting. I may adjust that, but let me just go back and show you the data that's driving this decision. So it's the 15-minute range guides for the futures. Oh, and interesting. The ES, the market I'm trading, is not a strong odd. So again, I'm waiting for confirmation. But overall, there was a slight bias. NASDAQ, now I could trade NASDAQ and Russell futures, and I've done it plenty of times. It's just not my preference. I generally prefer the ES, greater liquidity, less susceptible to stop runs, just a more liquid instrument. And I'm only going to trade when the S&P is at least neutral anyhow. Looking at the spider 15-minute range guides, that did confirm. So that makes me feel a little bit better about that. So, but Anyone can make directional calls. What's your stop and what's your target? 4-point target for me, 4-point stop. Systems are set up. Those change sometimes, but they're not optimized targets. Generally just showing when's the market made a decent move with a reasonable stop. So let me look at our price guide, and I slide this over so I can see it. Price guides. I want to see what this green area, that's multiple confluence areas. Scroll down. We're in the 50 area, way down here. So these green bands right here are the resistance I'm talking about. So we've got the low from 2 days ago, 52.75. Last month's close, 52.50. 0.618 extension to the downside is at 50. Yeah, so I could I'm just going to, I could maybe be a little bit more patient, wait for it to come back to 51 and a quarter, but the range is at 51.50, 51.75. So let's work backwards. I worry less about missing a trade than having my stop in the right place. If I go long, this rallies up and then pulls back, and I go long at 51.75, subtract 4 points, that's where my stop would be. That would be 47.75. It's just right there at today's open. I'd rather have it a tick below the open at 47 and a quarter. Every little thing matters. These are just guides, they're not systems. So I'm going to go back, change my mind. I am going to wait for it to pull back to S3 at 51 and a quarter. With a 4-point stop, gets it at 47 and a quarter. I'm either going to lose 4 points, or I'm probably going to make 4 points. I don't know which. I say probably. I don't know what's going to happen today. 51 and a quarter is what I'm looking for after it goes to 53.75. And again, there is a chance the train will leave the station without me, and I am okay with that because guess what? The first hour is coming out in 20 minutes. I'll have another opportunity to take a trade. I've learned it's hard, but I follow my rules and my methodology, and don't stress about missing a trade. Najib says, do you have results of possible get results these setups according to simple context like take only if 60-minute trend is in the same direction as the trade? We've got members in our trading room. A lot of folks track things like that. I don't. Some of them can share with you if you're interested. You can do a trial at Master Gap for $14 for 2 weeks. I don't have a hard close coming, folks, so you can relax. It's not my style. If you don't have 20,000 or more in your account, we're probably not a good fit for you. And quite frankly, you shouldn't be trading futures markets if you have less than 20,000. Now, a lot of our folks trade the ETFs, but again, I don't think even if you're trading the ETFs with less than 20,000, if you do the math, membership fees are 150 to 200 bucks a month. We do specials from time to time, but I don't even know. We don't have a date scheduled on another one upcoming. But you do the math on that over the course of a year. If you spend $2,000 with us and you've only got 20,000 on your account, you just spent 10% of your equity on education. Well, I think we're worth it. It's probably better than losing 10,000 following someone else at a less expensive site, but I'm biased in that regard. I think you ought to just save your money and do your homework. Read my book. I have a book on understanding gaps on our website, bottom left, or just go to understandinggaps.com. See if I can put something in the announcement tab. That doesn't look like I put it right here. These gaps can be used for more than just trading them, but you'll learn more about my approach in these zones that I've talked about. I think that's the URL right there. Jack says, what happens to these gaps that have not filled? It's a common incorrect perception that all gaps eventually fill because there's no way to know that. Let me just show you something. This is a daily chart, S&P futures. The white lines represent the unfilled down gaps. There have been quite a few unfilled gaps in either direction. We made 2 recently in the past few days. Look at all these unfilled gaps down below. It goes on and on, folks. So trying to trade around targeting unfilled gaps is a waste of time and money. Get the point? My analysis, and I haven't updated in a while, my analysis shows that the average time for a gap to fill is 10 to 12 days, and that's probably 5-year-old analysis. It's not a useful information. Here's what's useful though about an unfilled gap. If a gap remains unfilled at the end of a day, the odds of it filling on the subsequent day are only 25%. So I'll say that again. Let's say that today's gaps don't fill. So price doesn't make it all the way up to the green line up here. The top of the green candlestick, which is what it would take for this gap to fill. So if it remains unfilled, the odds of it filling tomorrow, regardless of where it ends up today, odds of it filling tomorrow, meaning trading all the way back up to yesterday's closing price at 60, what was it, 67 and a quarter, only 25% on average. Mr. PC says, thanks for being humble and honest in your work. Sometimes there's significant run between 4 and 4:15. Where do you establish the close? And what if the next day's open is between those two prior day times? Ooh, good one. This is more of a subtlety, but this is what he's talking about. 4:15 is when the futures close. That's when the pit session closes in Chicago. Let's see if I can show you a good example. Go back to 2 days ago. So Monday's price action. See the rally? This is what he's talking about. 3 candlesticks to the upside. That was covering of people that were getting short, or maybe opportunistic buying. You don't really know. But if I put my cursor on it, you'll see that the close here was, 1600 close, 1958. So 1958 is where in a relative sense, that's where this spider was closing at 4 o'clock. But it went all the way up here to right there, and that was 1650. That's a 2.5 point run. So I use the last trade. Settlement can vary a little bit from here as well. So I track all 3. But in the scenario that you suggest, Mr. PC, if the gap is a small gap down, and I'll trade a 1-point gap, but it's got to be a really strong, perfect setup. A 1-point gap down, had this happened yesterday, that was down for the futures, but up, right, we're compared to the 4 p.m. close where the ETFs closed. So you'd have the spider gapping up and the ES gapping down. No, thank you. I have no interest in getting caught up in that potential volatility and guessing, because here's what's going to happen. If the buyers and the ETFs are buying to fill the gap, they're putting counter pressure on my long correction. They're filling the gap. They're actually adding pressure there. But what happens if it goes the other way? So you don't know which side is going to win. You don't know if the futures are going to rally to push up or the ETFs rally to push down. So if the gap was up, the ETF traders would be pushing down. Sorry, I got a little confused there. So I just leave it alone. I will tell you, I pass on most large gaps. You can make a ton of money on these. The problem is the win rates aren't good enough. So let me talk about win rates. A lot of people say, oh, I just trade whatever the highest expectancy is. That's fine, but you have to be very diversified. You trade a 50-50 setup 100 times in the course of a year, it is probable you will have a drawdown of 6, 7, 8 losers in a row. Very possible to even have 9 or 10 losers in a row. And I don't know many people that can stick with their system of methodology after 8, 9, 10 losers in a row. And guess what? You're going to abort your plan at the worst possible moment. So it's very, very hard, no matter how disciplined you think you are. So I prefer to focus on strategies that have 60+% win rates. That means odds of having 5 losers in a row, they're not out of the question, are extremely low. Most years I'll only have 3 or 4 losers in a row. I think this year I don't think I've had more than 2 losers in a row. It's only halfway through the year, so every year is a little bit different. Jack says, sounds like too many ifs and moving parts in this method. Jack, appreciate the feedback. All I can say is you can choose not to look at the different pressures in play in the markets and go blindly into a trade, or you can choose to look at them. I totally understand the idea of not wanting to get overwhelmed. And again, I'm not going to dumb down what I do just to make it sound easy to do so that some of you will sign up on my membership site. If this isn't appealing to look at lots of data and evaluate, I mean, it is intimidating, and we're actually working on visual tools and simplifying our whole layout because our website, quite frankly, is not very good. but it works. It's really stable. So we're in the process of doing that. I'm just a big believer in, I like to put history on my side. Most of you are trading setups that you have no true edge and you don't even realize it. You think you do, but it's just a matter of time. Um, it's better to be selective, wait till the markets get imbalanced, trade very selectively. So that's what I do. To each his own. Mike says, Scott, 5150 has been hit. Shouldn't you be long? Nope. I said that it didn't quite meet my method. And I'm not just making this up for today. This has been my rules for years. 6 of the 8 indices need to confirm the setup. Why would I do that? Because if I don't have 6 out of 8 indices confirming the odds for that day, the win rate and probability is too low. The drawdown is too inconsistent. There's an edge, it just gets too choppy. So trade the best setups. Best setups will win all the markets that are highly correlated, like the Russell, the S&P, the NASDAQ, and Dow, are lined up together and moving in lockstep. They're moving in lockstep right now, but the odds aren't consistent. So it was only 5 of 8 my criteria. So what I said I would do is if the market confirms the breakout of the 15-minute range by moving at least 2 points to the high side, then I would buy a pullback to, actually set 51 and a quarter, which is 1 tick above S3, 1 tick below, as it turns out, the first hour range, and it'll get my stop just below the open. My typical stop loss orders, 4 points with current volatility in the range trades. Gap trades, I always use a minimum of 5 points in the ES. If you're trading the spider, it's like 50 cents in the spider or 40 cents on a range trade on the spider. It's shown on our guides or mathematical calculations. Here's another thing, it's a little provocative. Stops are overrated. You got to have one, but that's not how you make a strategy more successful. It's all about selectivity. If I had more time, I could show you, and I've done, here's a place you can go learn more. Go to thegapguide.com, just a free blog. I don't update it very frequently because I'm very busy with our members. And share mostly with our members internally. So go to thegapguide.com and you'll see some pretty interesting posts, in my biased opinion. That's gap size. Let's see, stops. Stops are overrated. So here's the point of stops being overrated. If you use a stop as a percent of the gap size, it could be 25%, it could be 200%, 2 times. Look at the direct linear relationship between win rate for that trade. The smaller the stop, the more frequently it is to be hit and you get stopped out. The bigger the stop, the less frequently it is to be hit and be stopped. But what is stunning about this chart, it should be and should stand out, is look at the profitability. Profit factor, ratio of historical profits to losses, historical gross profits divided by historical gross losses. They're all remarkably, in my opinion, right at 1. So really stops should be used to fine-tune your desired win rate. They're not going to change how much money you're likely to make over the long term. And this is a long-term game. Most people take a very myopic view on a given day, and that's just not the appropriate way to do it, in my opinion. The data doesn't support it. You can't figure out which ones you need a bigger stop, which ones you can't. Trust me. I've tried. Folks, everything I'm saying is based upon my own experiences, so we got to keep that in mind. You need trust but verify. But I do work with hundreds of traders and have done so for years. Okay, we're at 53.75. I'm setting up a buy order 51 and a quarter. 51 and a quarter. Trade at your own risk. 4-point target, 4-point stop. Now, if it goes all the way up or gets very close, I want it to pause here a little bit. If not, I'm going to miss the trade. The target, if I were going for the trade, is technically 50 at 4 points, 55.50. So if it will pull back here a little bit, and then I'll get filled to the long side. Otherwise, it'll be one of those trades I just missed because it wasn't quite strong enough. And I'll say, well, it pointed me in the right direction. That's good. I followed my rules. That's good. Missed a winning trade. Go to the next one. The first hour range shows are coming. Unfortunately, I don't have a way to change this. My data is it's automatic exactly 10:30 when I have to wrap up here. So they'll be on our member site exactly 7 minutes from now. Um, yeah, I mean, like I said, the Keltner bells and Ichimoku and all that, I haven't tested every single configuration. I do want to be clear, right? A lot of those things, even simple MACDs, et cetera, you can use different number of periods and so on. But I've tested to total, again, thousands of trades, scenarios to finally get my fat head through an understanding that there's nothing that evaluates the market perfectly. It has to be used in context with other things. When you start layering in multiple indicators, multiple time frames, you're adding in exponential layers of subjectivity. Um, and most importantly, even if you're successful with that, you don't know what the average stop size is, so you don't know how to position size, right? So you don't know if you're trading too aggressively and you're going to hit a bigger drawdown than you intend, or too conservatively and never achieve your goals that you intend. Position sizing is the answer to achieving your goals. If you haven't read any of Van Tharp's book, Van Tharp is a friend in the local area here in North Carolina, where I live, and he's written some fantastic books on position sizing, and he'll tell you exactly the same. I encourage you to check him out and read those books. What is my definition of imbalance? Cal, I don't know what context I use that. Definition of imbalance. Imbalance means when you've got the data is the markets are imbalanced would be one market showing a bullish bias, another market showing a bearish bias, or being set up in a way that historically they've shown that. That would be an imbalanced market where you've got cross currents in the markets that are not confirming as well as I like in order to take the best trades. So when you get cross currents where the Nasdaq's doing one thing, the Russell's doing another. And that's not today, by the way, where everything's moving along pretty good. Nasdaq is trying to lead to the upside. But that's what I meant. And let me just type my member site. If you're interested, I do a daily video. You can sign up for that. That evaluates, shows you what my plan was before at 9:20 in the morning each day. I review that, and you get to see the good, the bad, the ugly. And I'm explaining what worked, what didn't, and when I made money, when I lost money. Going to trials $14 for 2 weeks. All right, we've got 4 minutes left. Other questions for me before I wrap it up? I will leave this trade on. The best range trades work before noon, so and I'm going to be out of the office a good part of the afternoon, so I'll probably cancel the trade if I'm not filled. If it hasn't hit the target already or filled me, I'll probably cancel it by noon Eastern time. Frank, yes, I've got a third of, well, actually, I don't know the exact number. We did a survey of our members, though. About a third of our members have a part-time or full-time job. A third of our members are full-time traders. That's all they do. And a third of our members, for their income, all their income and so on. And a third of our members have another source of income like a retirement or a spouse that works. Frank, you can set up all our trades with, you'd have to check, well, it depends on the markets, right? Depends on the market you want to trade. The first market opportunity that our members are already doing is gold at 820. Then you got an 835 range trade on gold. And then at 9 o'clock, oil opens. Then you got a 915 range trade in oil, WTI down here. And then at 9:30, there's the opening gap trade. At 9:45, there's the, in the indices, that is, 9:45, the 15-minute range trade across indices. 10:30, the, oh, correction, 10, I missed a couple here. Gold at 10:20 for the first hour range, 9:20 for the first hour range trade. Oil 10 o'clock first hour range trade. And then at 10:30, these are all Eastern times, the first hour index range trades. 6 p.m. gap play. I, I I don't know. I prefer to spend time with my family. I've never studied at PC. But the cool thing is with the approach, I'll say this. So again, not I tend to be, the good, the bad, and the ugly, as I like to say. Um, with the data being spoon-fed to you and to me, it allows me and my folks to simply evaluate the market at the different times. You can go work out between 9:45 and 10:30 if you're not trading, for example, the first hour range in oil. You don't trade that market. Um, it allows you to let the market come to you, evaluate the historical setups objectively without emotion, and see if there's a historical bias. If there is, you set it up with a predetermined target, just like I've got set up right now, and a predetermined stop, and I can go about my day.
All
Yeah, I don't
right.
know.
Well,
Oh, I think that's my time. Thank you all. Appreciate your interest, and thank you for